2022, a group of people met in a room in Washington, D.C. You didn't vote for any of them. You've probably never heard most of their names. And the decision they made in that room made your mortgage more expensive, made your car payment bigger, made your credit card interest jump, made millions of Americans reconsider buying homes, starting businesses, taking out loans. All of it from one meeting that you had no say in. Who are these people? And why do they have that much power over your money? Meet Deshaun. He's 31, lives in Columbus, Ohio. He saved for years to buy his first home. In early 2021, his monthly payment would have been around $1,200. By late 2022, same home, same credit score, his payment jumped to nearly $1,900, $690 more every month. Over 30 years, that's more than $240,000 extra that he didn't plan for. Deshaun didn't make a bad decision. 8 people met in a room he wasn't in, and it changed the math on his entire life. Today, we're going to show you who those 8 people are, what they actually control, the 3 tools they use to move the entire American economy, and what happened the last time nobody was in that room and the whole system nearly collapsed. All right, let's build this from the ground up. That room Deshaun never got to vote on, it's called the Federal Open Market Committee. And before we tell you what it does, we need to fix the picture most people have of what the Fed even is. When most people hear Federal Reserve, they picture one powerful government bank in Washington, run by the president, printing money whenever it feels like it. Almost none of that is accurate. The Fed is not a regular bank. You can't open an account there. It doesn't deal with ordinary people at all. It's not a government department. It was created by Congress, but it operates independently. The president cannot call the Fed chair on a Tuesday and tell them to lower rates. And it's not a single building. It's a board of governors in Washington, plus 12 regional Federal Reserve banks spread across the country. New York, Chicago, San Francisco, Atlanta, Dallas. It's a network. Here's what it actually is. The Federal Reserve is America's central bank, the bank for banks. Every regular bank, Chase, Wells Fargo, your local credit union, they all have accounts at the Fed. When they need to borrow money overnight to balance their books, they borrow from each other. And the rate they charge each other for that overnight loan, that's set by the Fed. It's called the federal funds rate, and it is the single most watched number in all of American finance. Here's the image that makes it click. Picture the economy as a giant shopping mall. Every store is a bank. The Federal Reserve is the mall management office. It doesn't run any of the stores, but it controls the temperature, the electricity, the flow of people through the building. If the management office gets the conditions wrong, every store in the mall feels it. The Fed doesn't sell you anything directly, but it determines the cost of every loan you take, the price of everything you buy, and the health of every job market you work in. Here's something most people don't know. The Federal Reserve almost didn't exist. For most of American history, there was no central bank, no backstop, no lender of last resort, just banks operating on their own rules, their own reserves, their own luck. And the result? Banks collapsed without warning. People lost their entire savings overnight, and the economy crashed over and over, sometimes for years at a time. It took one of the most terrifying financial panics in American history to finally convince the country it needed a Fed. And the story of how that happened is one of the most dramatic moments in all of American financial history. Picture New York City, October 1907. It starts with a failed attempt to corner the copper market. 2 speculators try to manipulate the price of copper stock, and it blows up spectacularly. The banks that financed their scheme start to look shaky. Rumors spread. And in 1907, there was no deposit insurance, no government guarantee. If your bank failed, your money was just gone. So people panicked, and they did what anyone would do when they think their bank is about to collapse. They ran to get their money out, all of them, at once. But here's the thing about banks. They don't keep all your money in the vault. They lend most of it out. So when hundreds of thousands of people showed up at the same time demanding their cash, the banks didn't have it. One by one, they started to freeze, then fail, then collapse. The panic spread like a virus. From New York to every corner of the country, businesses couldn't get credit. Workers stopped getting paid. The stock market lost nearly 50% of its value in weeks. The entire American economy was on the edge. And you know who stepped in to stop it? Not the government. There was no mechanism for that at this scale. It was a private banker named J.P. Morgan, the most powerful financier in America. Morgan personally called together the heads of the major banks, locked them in a room, and forced them to pool their money and support each other. A private bailout. By sheer force of personal authority, he stopped the bleeding. It worked. The panic ended. The economy stabilized. But the whole experience left Congress deeply shaken, because now everyone was asking a terrifying question. What happens next time when there is no J.P. Morgan to save us? What if the next crisis happens when the most powerful banker in America is sick sick, or dead, or simply refuses to help. The entire stability of the American economy could not depend on the goodwill of one private citizen. So Congress spent the next 6 years designing a solution. In 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The Fed was born. Its job, be the permanent institutional version of what J.P. Morgan did in 1907, the lender of last resort, the thing that stops a panic from becoming a collapse. That was the origin. But in the century since, the Fed's role has expanded considerably. What started as a lender of last resort became the institution that sets the price of money itself. And that is where the controversy begins. We promised you something uncomfortable in part 3. Here it is. What the Fed did in 2020 made asset owners, people with stocks, real estate, investments, dramatically richer. And it contributed to the inflation surge that hit everyone else in 2021 and 2022. We're going to show you exactly how. And it comes down to 3 tools. Think of these as 3 different dials on the same control panel. The Fed uses all 3, sometimes together, sometimes separately, depending on what the economy needs. Tool 1, the federal funds rate, the price of money. This is the famous one, the one you hear about every time the Fed meets. The federal funds rate is the interest rate banks charge each other for overnight loans. Banks lend to each other constantly, just to balance their books at the end of each day. When this rate goes up, borrowing gets more expensive across the entire economy. Banks pay more to borrow from each other. They pass that cost on. Higher mortgage rates, higher car loans, higher credit card rates. The whole economy slows down. When the rate goes down, the chain runs backwards. Borrowing gets cheaper. Businesses expand and hire. Spending picks up. The economy warms. Think of the federal funds rate like the water pressure in a building. High pressure, money flows freely through every pipe. Every loan, every mortgage, every business credit line gets fed easily. Low pressure, money flows slower. Borrowing gets harder. Spending cools. In 2022 and 2023, the Fed raised rates 11 times in 18 months, near 0 to over 5%, the most aggressive rate hiking cycle in 40 years. Each hike was felt immediately by anyone with a variable mortgage, a credit card balance, or a business loan, including Deshaun. Tool 2, reserve requirements, the safety buffer. Here's something most people don't know about banks. They don't keep all of your money in the vault. When you deposit $1,000 at Chase doesn't just sit on it. They lend most of it out as mortgages, car loans, business credit. They pay you a small rate on your deposit. They charge a higher rate to borrowers. The difference is their profit. That's how banks work. But this creates a problem. If too many customers show up at once demanding their money, like in 1907, and the bank has lent most of it out, they can't pay everyone. The bank fails. So the Fed sets reserve requirements, a minimum percentage of deposits banks must keep on hand and cannot lend out. It's the safety buffer. In March 2020, the Fed dropped reserve requirements to 0 to push banks to lend as much as possible during COVID. A reminder that these tools are not fixed. The Fed adjusts them based on what the economy needs in the moment. Tool 3, open market operations, the flow of money. This one sounds the most technical, but once you see it, it's actually pretty clean. Open market operations means the Fed buys and sells government bonds, called U.S. Treasuries, in the financial market. By doing that, it directly controls how much money is flowing through the whole system. When the Fed wants to inject money into the economy, it buys bonds from banks, paying with money it creates electronically. The banks receive cash, more to lend, more spending. Economy gets stimulated. When the Fed wants to pull money out, it sells bonds back to banks. The banks pay cash. That cash goes to the Fed and effectively disappears from circulation. Less money, less lending, less spending. Economy cools. Think of the economy as a swimming pool. The money is the water. Open market operations is the Fed controlling the valve. Buy bonds, open the tap, the pool fills. Sell bonds, open the drain, the pool empties. During COVID in 2020, the Fed bought trillions of dollars worth of bonds, flooding the pool faster than at any point in American history. It kept credit flowing, stopped the economy from seizing up entirely. It also contributed, alongside other factors, to the inflation surge of 2021 and 2022. The people who owned assets when the pool flooded got dramatically richer. The people who didn't own assets felt the inflation without the gains. That is the uncomfortable truth we promised you. Every tool has consequences. The Fed knows this, and it uses these 3 levers constantly, adjusting, calibrating, responding in real time to an economy that never sits still. Remember Deshaun? We're going to finish his story and show you how it connects to your mortgage, your car loan, your credit card, your savings, and your job. Your mortgage. In early 2021, Deshaun was pre-approved for a 30-year mortgage at 3.2% on a $280,000 home. Monthly payment around $1,210. He waited a little longer, wanted to save a bigger down payment. Reasonable, responsible. By late 2022, rates had climbed to 7.2%. Same home, same Deshaun, same credit score. Monthly payment now? Around $1,900. That's $690 more per month. $8,280 more every year. Over the life of the loan, more than $240,000 in additional interest payments. Deshaun didn't do anything wrong. 8 people met in a room he wasn't in, and it cost him nearly $250,000 over 30 years. That's not a policy number. That's someone's life. Your car loan. In 2020 and 2021, dealers were offering financing at 0 to 2% APR. Buy a $35,000 car at 1.9%. Monthly payment around $610. By 2023, average auto loan rates had climbed above 8%. Same car, same loan term. Payment now around $710, plus nearly $7,500 in interest over the life of the loan. The car didn't change. The Fed did. Your credit card. Credit card rates move almost directly with the federal funds rate. In 2021, average APR was around 16%. By 2024, it had climbed above 21%. If you carry a $5,000 balance, which millions of Americans do, the difference between 16 and 21% is an extra $250 a year on a balance you're already trying to pay down. The Fed raised rates to fight inflation, but the people paying the most direct price were the ones already in debt, the ones who could least afford it. Your savings account. Here's the other side, because when rates go up, it's not all bad news. In 2021, high-yield savings accounts were paying around 0.5% per year. $10,000 in one, you'd earn $50 for the year. By 2023, those same accounts were paying 4.5 to 5%. Your $10,000 now earns $450 to $500, 10 times more, without doing anything differently. People with savings got a meaningful raise from the Fed's rate hikes. People with variable rate debt got a bigger bill. Same decision. Two completely opposite outcomes, depending entirely on where you stood when the lever moved. Your job. This one is the most invisible, but possibly the most important. When the Fed raises rates aggressively, borrowing gets more expensive for businesses too. Companies that were planning to expand, hire, build, suddenly those loans cost significantly more. Some projects get delayed, some get canceled. Some companies start laying off workers to cut costs before revenue slows. The 2022 and 2023 rate hikes contributed to waves of layoffs across technology, real estate, and finance. Not because those companies suddenly became unprofitable, but because the cost of money went up and the expectation of a slowdown made them defensive. The Fed's goal was to cool inflation, but the way that goal gets achieved runs directly through business investment and employment. Real people lose real jobs. The Fed understands this completely, and it wrestles with it constantly. So now you know what the Fed is, how it was born, and what it does to your everyday life. Here's where it gets controversial. Some of the most respected economists in the world call the Federal Reserve the greatest financial stabilizing force in human history. Others look at the exact same institution and call it the primary cause of wealth inequality in America. Both sides have evidence. Both sides have Nobel Prize winners. And the argument between them is really an argument about one question. Whose money is the Fed actually protecting? 4 voices. Let's hear the room. Expert panel, where smart people disagree. The Fed defender, central bank institutionalist. Without the Federal Reserve, the 2008 financial crisis would have become a second Great Depression. When Lehman Brothers collapsed and credit markets froze, it was the Fed that stepped in. The Fed is imperfect, but it is the only institution with the tools to prevent financial catastrophe at the system level. Remove it, and you get 1907. Every decade. The Fed critic, free market economist. The Federal Reserve is the greatest source of moral hazard in the American economy. When banks know the Fed will rescue them in a crisis, they take risks they would never take otherwise. They privatize the gains and socialize the losses. A truly free market would discipline bad actors. The Fed protects them. The inequality economist. Look at what quantitative easing actually did. It flooded the financial system with money. Where did that money go? Into asset prices, stocks, real estate. The people who owned those assets got dramatically richer. The people who rented and worked hourly jobs felt none of the benefit, but they felt all of the inflation that followed. The behavioral economist. The most underappreciated problem with the Fed is what people think it can do. Every time stocks drop, everyone looks to Washington for a rescue. This has created an economy where risk is never fully priced because everyone assumes a permanent safety net. That disconnect is how you build the next crisis. 4 voices, 4 completely different diagnoses of the same institution. And here's the thing. All 4 of those things can be true at the same time. The Fed can be necessary, imperfect, structurally biased toward asset owners, and a source of dangerous moral hazard, all simultaneously. Wrestling with that is more honest than picking one side. Remember that room in Washington, D.C. from the beginning? The people you never voted for. The decision you had no say in. The ripple that made Deshaun's mortgage jump, made your car payment bigger, made credit card bills grow across the country. That room doesn't feel quite so mysterious now. Here's what we covered today. The Fed is America's central bank. The bank for banks, created after the panic of 1907 to be the backstop the private sector couldn't reliably provide. It has three tools. The federal funds rate controls the price of borrowing, reserve requirements control the safety buffer, and open market operations control the flow of money itself. Those tools showed up in Deshawn's mortgage, in your credit card's APR, in your savings yield, and in the layoffs your colleague went through last year. The experts gave us the full picture. The Fed is necessary, imperfect, structurally biased toward asset owners, and possibly building the conditions for the next crisis it will have to rescue us from. All of those things at once. Here's the version a 12-year-old could understand. Imagine a football coach who controls the game clock. When the game is moving too fast and players are getting sloppy, the coach slows it down. When the game is dragging, the coach speeds it up. The Federal Reserve is that coach. Your mortgage, your savings, your credit card, those are the players. The game clock is the interest rate. The goal is always the same. Keep the game moving at the right speed without anyone getting hurt. The Federal Reserve is not background noise. It is the background itself. Every financial decision you make happens inside the conditions it creates. And now that you understand those conditions, here's what you actually do with that knowledge. When the Fed signals rate hikes are coming, lock in fixed-rate loans before they get more expensive. Keep your emergency cash in a high-yield account, not a big bank paying 0.1%. Avoid variable-rate debt during hike cycles. And when the Fed makes headlines and the market drops, don't panic sell. The Fed's moves are temporary. Compound interest, as we talked about last time, is permanent. You can't vote for the Fed. You can't opt out of its decisions, but you can stop being surprised by them. If this video finally made the Fed make sense, hit the like button. It helps more people find this channel. And frankly, more people need to understand this stuff. Subscribe to Pennywise Planning. No jargon, no agenda, just money explained the way it always should have been. Clear, straight, and actually useful. Drop a comment below. Before this video, what did you actually think the Fed did? I'm curious. And you'd be surprised how many people had the exact same wrong picture. Next video, physical versus digital banking. Your phone now does everything a bank branch used to do. Faster, easier. But is it actually safer? What do you lose when the branch closes for good? And what does the future of money look like when there's no building to walk into? That video is next. Subscribe so you don't miss it. See you there.